with you. We all know that starting early with investments can set the stage for financial success. What do you think? Why do you think, rather, it is so important for young earners to begin investing as soon as possible? And in your opinion, how can mutual funds help them build a strong financial foundation?
Okay, first of all, thank you so much for having me. I'm very excited for this event. And for me, any student or college student or someone who's very early in their career, first step, what they need to learn is how to manage money, right? Wherein with their money, they know this is the money that they want to have fun with, this is the money they want to reinvest in themselves, this is the money they want to invest for their future for the long term. And it is so crucial for them to understand this because of the fact that once someone just starts with mutual funds, and that too simple passive index mutual funds, the return and the compound return long term are extremely strong, and this gives a very strong edge to that student for the rest of his life. So for me, the best and the easiest way to start for any student is not to wait for the perfect time, not to wait for him or her to learn the entire stock markets and then start. Rather, start off with passive mutual funds and slowly and steadily keep building on your knowledge, keep building on your finances, and moving on.
Absolutely. All right. Amit, let me come to you for your perspective on this, because young earners often have limited budgets. They are, of course, now more than ever eager to start investing. So, what innovative approaches can they take to diversify their investment portfolios without needing much capital? We need to start somewhere. The idea sometimes is that we feel, oh, it's not that much. I'm earning a very lower salary. So, what good is it going to do right now? Starting that journey as early as possible, the need for it, the strategies required for it. Your thoughts on it?
Yeah, hi Gautam and hi everyone, and thank you for having us on the show. I think Gautam, more importantly, the biggest change what I have seen in our generation and the millennial and the Gen Z generation is that instead of savings, expenses have taken precedence. So the first and foremost thing is income minus savings is equal to expenditure. That has to be drilled into all the millennials' curriculum. We have been taught income minus expenses is savings, and that is what we try to put as the savings into funds. But what this generation needs to really think of is income minus expenses is savings. They are trying to get into these credit card traps. They are trying to get into these zero EMI traps. And mind you, whenever you have something which is free, like zero interest, you are the product. So before buying the next iPhone on a 6-month free EMI, just try to think that if you can save that money, even if it is 1,000 rupees a month, that can really create a very good corpus going forward. People don't really feel the power of a small SIP, how much can it actually deliver over long periods of time. If you really try to look at this 6,600 rupees a month, say at 15% CAGR over 20-year period, Gautam makes you 1 crore. So it's not about the amount at all. It's just that you need to have that discipline and you need to keep on continuing it for long periods of time. I've seen a lot of my young investors. Uh, they are of the opinion that they don't need to buy a house because the job can take them anywhere. But they are very cognizant of the fact that medical is going to be one big expense for them, and the life goal for them is traveling. The life goal for them is spending money on luxury products, but the priority for them definitely is medical. I think that's the
Hmm.
sea change. So even a small SIP over long periods of time will be needed actually for your medical expenses going forward, the way inflation is taking that up.
Absolutely. And you've raised a great point here because most of the time it's the lack of definition of a goal which creates a problem. I faced that issue when starting my investment journey when my financial advisor asked me about what my goals are, and I had to really sit and figure out how exactly is my money going to enhance my life. And buying something just for the short term pleasure of it is not exactly a goal that many of us look for. As you mentioned, there's health to take care of, there is retirement to take care of, many of the broader goals which we first need to set, and then maybe we start looking at these little goals where it's either a vacation or you want to buy a new phone. Those come into picture. So great point raised there, Amit. We'll come back to you on some other points. In the meanwhile, Manish, let me ask your perspective on balancing risk and reward, because that is crucial in any investment strategy. So I want to understand from you, what strategies can young earners use to achieve this balance in their portfolios, and how mutual funds can help in this process?
Right. So, good afternoon, everyone. Thank you for inviting us. Uh, I'll just take a minute to explain what is risk and what is it that we need to keep in mind. So, it's an old cliche, whether you drink water in Bangalore, Barabanki, or Boston, the formula remains H2O. Similarly, the risk return trade offs remain same, irrespective of which geography or which asset class you're investing in. So you need to keep in mind every time you're looking for a higher return, you are building in risk in the portfolio. And by risk, I mean not only the returns not accruing, but the principal not growing in real terms or principal even eroding. And the corollary of that is that if something's given you a higher return over the last 1, 2, 3 years, please understand it's carrying a lot of risk in it. To give you a simple example, the risk-free return, if we were to say in India, is the rate at which the government of India can borrow, which is right now 6.85% for 10 years. Anything that you're looking to achieve over and above that, you have to start with the assumption that you're building risk in the portfolio, and the returns that you chase will always have risks in them. And anything that has given a higher return over the last 2, 3 years, and if you think that's going to continue to happen in the coming years, has a lot of risk built in. So that's the first thing. That's a thumb rule we always need to keep in mind when we are building a portfolio. Now, how do we manage this risk? At the end of the day, not doing anything is also a risk. Your money gets eroded in real terms if you don't invest. The free lunch of risk management, as they say, is diversification. It's an old way, the way we were taught when we were growing up. When you're traveling in a bus or in a train or public transport, don't keep all your money in one pocket, keep it in two pockets. So diversification is the free lunch of risk management. So diversify across asset classes. Don't put all your eggs in one basket, and diversify. Mutual funds are a great way of diversifying, not only across asset classes, but also within the asset classes. So when you do a diversified equity mutual fund, you are basically participating in multiple companies. So important thing, the sooner we realize this, and I know there is a lot of recency bias and a lot of our investors come and say, oh, this fund's given this much return in the last 1 year, why don't we put more money in this? We always need to keep in mind that anything that gives a high return has a lot of risk built in, and as you chase higher returns, you are building in risk in the portfolio. And the best way to manage risk, one of the better ways of managing risk, and like I said, it's a free lunch of risk management, is diversify across asset classes, diversify across instruments, and if possible, diversify across geographies. And mutual funds are a fantastic product to start your journey of diversification.
An investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। स्कीम संबंधी सभी दस्तावेजों को ध्यान से पढ़ें।